First of all, we had a fantastic quarter in the face of the Delta variant. You think about it. This was a record Q4 for the company. It was a record fiscal year 21. We grew revenue this last fiscal year at 24%, which is faster than the addressable market of coffee. So we are taking market share in all things coffee. And we did that in the face of COVID restrictions that were implemented city by city, state by state, and market by market related to Delta variant. We did it in the face of a global supply chain dislocation, and we did it in the face of inflationary pressures. And so I think we posted a very, very strong performance, and we are taking market share. I think that's an important point to take away from this last quarter and the last fiscal year.
But Kevin, your CFO spent a lot of time talking about how the so-called algorithm, which I know is hard for people at home to understand, that you have to go lower, that there's going to be a pause in 2022, fiscal year 2022, and people just have to adopt that. You do announce the very good buyback, but things aren't going to really refresh till 2023, so there is a bit of a gulf, and I will say that what you may have done in the past is not going to happen in 2022 by your company's own admission.
Well, Jim, think about this. Our long-term growth model is to deliver double-digit EPS growth at scale, and we committed to delivering at least double-digit EPS growth in this fiscal year 22. So don't be confused by that. I think what people react to is we just made a significant strategic investment in our partners. And so why did we do that? We did that because throughout the 50-year history of Starbucks, we know that when we invest in our partners, they in turn rise to the occasion and they take care of our customers and create that great Starbucks experience that we all expect. This is the inflection point. This is the moment for that investment. Why? Consumer mobility is increasing. As consumer mobility is increasing, we want to make sure that we are capturing significant market share of customer visits to away from home coffee. And if we capture that market share is permanent. It's not transitory. This is a moment to invest in our partners, to serve our customers, capture that market share. And if you look at the numbers, that fundamentally will increase the terminal value of Starbucks. And we're so confident in this strategy that we have announced we're going to return $20 billion to shareholders over the next 3 years in the form of share repurchases and dividends. So we are bullish on the future. We're confident in this investment. And like the other strategic investments we've made throughout this pandemic, giving our partners economic certainty, that paid off for us. Trade area transformation, where we repositioned 800 stores in North America, that has paid off for us. The investment we're taking today will also pay for us.
No, I thought the quarter itself was good. I favor the investment, but we have to deal with analysts like the Stifel analysts in a piece called Crouching Margin, Hidden Earnings, did say, I know, the company anticipates offsetting a meaningful portion of the inflation, definitely, but the guide was significantly below the current street consensus. I found it like this, Kevin. You called it's an investment year. Now, there's nothing wrong with calling it an investment year. You have to do it in order to be able to beat everybody. But you have to own the fact that you are going to do that, and it is not going to give you the same level of growth that you'll get in 2023. Don't you have to own that?
Well, we do own it, but I actually think this accelerates the growth as we get into the out years. Certainly for fiscal year 22, we have some slight margin compression from our typical 18 to 19% operating margin range. This year will be 17%. We're offsetting much of those investments with productivity in our stores and pricing actions. But there is a slight margin compression. But if we gain this share, Jim, we get operating leverage. We've seen that before. And when we get operating leverage, it's like a slingshot on operating income. So when you look at the future, this really is a strategic investment for accelerated growth for Starbucks. And it's better to do this investment now as customer mobility is increasing. And we believe it's the right strategic bet for us to take. We believe in our partners, and we're going to lean in at this point in time.
Hey, Kevin, a big part of the Starbucks experience is talking to the barista, but you did mention automated ordering last night. I'm wondering, can you expand on that and sort of give our viewers a sense of at what point would their experience, their normal Starbucks shopping experience, be at a kiosk and not with a human?
Yeah, we're not embracing the kiosk concept. You know, certainly the automated ordering is on our mobile app, and if you look at what we've done digitally, we have created digital customer relationships with nearly 25 million active 90-day active rewards members in the U.S. and over 17 million active rewards members in China, and those relationships are personalized. And so that is playing a role. I think we also mentioned, though, that we have Deep Brew, our artificial intelligence engine, is doing automated inventory management and store ordering. So where we're using artificial intelligence and technology is to free up our partners from administrative tasks they do in the store so they can spend more time connecting with our customers. You know, and that's why we've seen our customer connection scores continue to go up. In fact, China this last quarter posted a record in their customer connection scores, and the U.S. is up as well. So we're going to continue to be all about that customer connection, and we're going to invest in our partners to ensure we do just that.
Shepard Smith here. Thanks for watching CNBC on YouTube.